episode 57 of Let's Talk Bitcoin, a twice-weekly show about the ideas, people, and projects building the digital economy and the future of money. Visit us at letstalkbitcoin.com for our daily guest blog, all our past episodes, and of course, tipping addresses. My name is Adam B. Levine, and today we're talking about the future instead of the past, and the theoretical instead of the practical, in that order. Daniel Larimer is the driving force behind Project Kiot, BitShares futures markets, and the ProtoShares decentralized CPU mineable currency that he hopes will power it all. Our talk on episode 44 about Project Kiot, the secure identity money communications platform, was one of the most popular we've ever run, and I caught up with Daniel a few days ago to catch up with what comes next. Then, you might have heard it, Bitcoin is broken and selfish mining is to blame. Hair on fire headlines aside, Andreas has got a bee in his bonnet on this one, and we not only break down the problem, but get a great example of how the core dev team has fewer but better options for dealing with things like this than your standard currency. Stephanie, Andreas, and I really dig into this one, and there's meat on those bones. Enjoy the show. In the past, we've talked about identity solutions that utilize blockchain sort of like systems in order to get where they're going. One of the most interesting ones that's under development right now is called Project Kiot. And Daniel Larimer, CEO and founder of Invictus Innovations, joins us to talk again about Project Kiot and kind of what's happened since we last learned about that project. Daniel, thanks for joining us this morning.
Thank you for having me, Adam.
For those who didn't hear, I think it was episode
44, I believe,
of Let's Talk Bitcoin. Can you give us a brief overview of what Kiot is all about, what the point is?
Kiot combines your money, your identity, and your communication into a single application with the goal of providing a next generation internet that's secure.
So the last time we talked about how you could essentially mine for these names. It was a way to prevent people from just camping on names because you couldn't sell them, and there was this whole auction-based mechanism system set in place. So all of that is still, that's still the plan, right?
What we have is a Kiot ID blockchain, and this is a blockchain for reserving usernames, like email addresses. Allows you to communicate with other people. These names are mined into existence, and you build up investment points. The more you mine on your own name, the more investment point you get on your name. And this is used to prevent sock puppets, for spam filtering, for prioritizing posts on forums, deciding whether or not to allow someone to create an account. Kind of like a way of filtering out risk accounts from real people. Because it takes a lot to invest in creating a name for yourself, there's a high price you have to pay to sacrifice your reputation just because you want to cheat someone out of $10 or something like that. So you want to keep these names around, and the more you invest into it, the more faith people have that you're not just going to throw your name away at the first opportunity.
So this is that problem again of verifiable identity, where you're trying to make it so the identity is verifiable, but it doesn't necessarily have to tie back one-to-one to your real life financial identity. This is and so you're able to maintain multiple identities with a system like this just as well as you are one, right?
Yes, you can create multiple identities. They could be anonymous or pseudo-anonymous, or they could be tied to your real world identity with services like VeriSign that will sign your identity and say, yes, you are indeed who you say you are. And the system will handle all of those things eventually. Initially, it's mainly for pseudonyms, though we have plans in the future to add support for tying it to your real world identity.
You had a kind of a public rollout and reveal of this project and a lot of the other projects that you're working on in Invictus at the Georgia conference at the beginning of October. What's gone on since then, and what are you working on now?
At the C3 conference, we started talking about releasing Kiot in November, starting mining for BitShares in November as well. We spent the past month working toward those goals, and we've made great progress. The biggest announcement we have on the Kiot side of things, we're now taking pre-orders for names in the Genesis block of Kiot. And these names are names that last forever, and they'll be given an honored position. So anytime someone emails it or enters your name into Kiot, they'll show up in a special way. They're lifetime names. You never have to renew them. And we're adding as many other benefits as we can think of to these names, but they should have a lot of default trust because they'll be in the Genesis block. People will know that, well, you didn't invest mining power, but you did provide some Bitcoin to help fund the development and promotion of Kiot.
So this is being done as a way to raise funds?
Yes. Invictus started to develop BitShares primarily, and along the way we came up with the Kiot and the mail system. We're trying to raise funds to continue the development and enhancement of our decentralized communication platform. This is what we found to allow people to get involved, to have a name that if this takes off and goes where we hope it's going to go, it'll be like having your name in the Genesis block of Bitcoin. You're famous.
What does it cost to have one of these early access names? They're not actually early access, you're reserving one, right?
Yes. So the benefits of reserving is that it's a highest bidder for the Genesis block, and they're more of a donation. So the more you donate, you get priority pick on which name you'd like.
How much does it cost to pre-order one of these names?
We are accepting pre-orders with our new cryptocurrency called ProtoShares, and the minimum amount is 100 ProtoShares to get a name. And these are something that you can mine with your CPU or buy them on our forums.
So what is a ProtoShare? Because we've been talking about BitShares to this point, and we've talked about the Kiot blockchain. I'm not familiar with what ProtoShares is.
ProtoShares is our way of doing an IPO for all of the different DACs that we are going to create here at Invictus. It is based on Bitcoin. It uses a new CPU-friendly proof of work. And for every ProtoShare you acquire, we will honor that many shares in the new future DACs. So when BitShares does come out, you'll get 1 BitShare per ProtoShare. When our other DACs come out, whether it's domain shares or other variants you can read about on our website, they will also honor your position in ProtoShares. So ProtoShares are a way of getting a stake in everything we are doing here at Invictus.
I know that you've been working on doing entirely new code for like the Kiot client and things like that. That's not based off of Bitcoin. Is this based off of Bitcoin?
Yes, this is directly based off of the most recent version of Bitcoin. We did that because it'd be faster. There's a long development time to do things new and clean. So we opted to just use the latest Bitcoin code base so that we could raise money, like you said, in a new decentralized way, help us vet our ideas and prove that there's interest.
So what exactly happens with the ProtoShares? Do they eventually go away? I mean, what happens to them? Is this a short-term thing?
ProtoShares mine out over 2 years. Most of the mining will be done within the first year because that's the big development phase when we're going to be building most of our software. But their long-term use is beyond that because we will be releasing variations on BitShares for different exchanges, whether it's for a commodities exchange or a stock exchange. ProtoShares will continue to be a way to speculate on the value of any future DAC that Invictus releases.
So you mentioned a forum. Where can people go to see that?
We've got a new forum at bitsharestalk.org. Replace Bitcoin with BitShares, and it's just like Bitcoin Talk. You can visit our website at invictus-innovations.com. You can read all about it and the benefits of Kiot ID, where it's going to be used. And there's a form you can fill out that will allow you to provide the information, your email address, the name you'd like. A week or two, we'll be allowing the download of the Kiot client. You'll be able to use Kiot at that point in time in a manner very similar to BitMessage, where if you share your public key with someone, it will work. This is going to be our beta test period. During this time, you can get an idea of what Kiot is going to look like, what the ease of use is going to be like. Then on Christmas Eve, the pre-order period stops, and we launch the Genesis block of the Kiot ID system New Year's Eve with everyone's pre-ordered names in the Genesis block.
When you release the Kiot client next week, the test, is that going to be for everybody or is it just going to be for people who have reserved names?
It'll be for everyone.
Now, I know that you've raised funds in other ways. Is this partly fundraising and partly about sort of starting to get the word out about the system? Is that right?
Yes. There's actually two goals. We're trying to raise money, get revenue into the company so we can keep delivering on these amazing products. That's one aspect of it. The other aspect is we want people to find out about what we're doing, about our mission to make the internet secure and protected from the NSA spying, whether it's through your communications, your e-commerce. And Kiot is going to be the gateway. I've actually posted some YouTube videos that describe Kiot in great detail, how the current internet is insecure, where we need to go to actually secure the internet, and where Kiot fits into that. Kiot becomes almost the next generation web browser, and your Kiot ID replaces your email address and your online identity.
How does that work? I mean, we've talked about it. Kiot, in the context of Bitmessage, there are a lot of similarities, but then you've added an additional layer on top of it with the name system and the direct connections. You know, again, for people who didn't catch that earlier episode, can you talk about what it is that you're actually trying to do, what the problem you're trying to solve is?
The primary problem we have is tying a name to a public key in a way that cannot be spoofed. Traditionally, the way this is done is you have certificate authorities like VeriSign that will sign the public key for your domain names that you're visiting. The problem is the NSA can force these companies to forge signatures. You can't really trust it. It's a centralized solution. So we've replaced the certificate authorities with a blockchain. The other way this is done is with PGP, where people send each other's keys and you kind of have a web of trust. But there's no real central server. You don't know where to go. No authority. What name is the actual name associated with the public key? So if someone gives you the wrong public key, you could end up sending your message to the wrong person. And with the Kiot ID blockchain, we solve that particular problem. The other problem we solve with the Kiot IDs is that it eliminates the need to use passwords to log into websites. Currently, when you log into anything, whether it's your bank or Let's Talk Bitcoin or Bitcoin Talk or any of these other websites, you send over a password. The website receives your password, and in theory, if you use that password anywhere else, they can steal your identity, which means you have to use a different password with every company you do business with. The other problem with using the password-based approach is that the SSL certificates that you use for sending over the connection is compromised. The NSA can get access to your password and have complete access to your online identity. The last problem we're solving is the fact that your email address is your identity right now. Anytime you need to reset your account information, you forget your password, they confirm it through your email and they allow you to reset it on your email. You don't own your email address. At any time, Google or Apple or Microsoft or Yahoo can come along and disable your account. They can send emails as you if they wish. So it's a system where you're allowing someone else to control your identity. Kiot IDs and our email system entirely replaces all the problems with a decentralized solution.
If the system that we're moving away from with certificate authorities is a few people making judgments, but there's a centralized list, so it's useful from that perspective. And the system that we, see with Web of Trusts is where there's really no central authority, and so there's no means of coordination. This is kind of like a hybrid approach where you take the consensus from the Web of Trust side, but you take the centralized sort of database structure from the centralized side. So you've got the centralized repository, but you don't have the arbitrary nature of the entity running it. Is that right?
You're correct. Just like Bitcoin, you reach consensus about what names belong to different public keys, and the cost of forging it is far too high to do so properly.
Now, Kiot is one element of this project that you're working on, but the other side of it is BitShares, which is a very ambitious project that we've been talking about this concept of distributed autonomous corporations as opposed to talking about alternative cryptocurrencies. Can you talk a little bit about BitShares and what you're trying to do with that?
I came up with the notion of a distributed autonomous corporation when I was trying to explain BitShares. I think it'd be helpful to go through the analogy I used to describe BitShares as a distributed autonomous corporation. A DAC, for short, is kind of like a company. It's got equity, it's got stock. You can trade the stock, and DACs pay dividends based on profits earned. But there's no centralized company that's actually backing it. It's not like stock for Apple in a blockchain. It's a business that has operating rules. It's performing a service and generating a profit. That's the concept of a DAC. So let's look at a decentralized bank and see if we can create a bank that doesn't have any corporation backing it, yet can do everything a traditional bank can do. When I go through this analogy, I think you'll find it's amazingly straightforward how you can create dollars in a decentralized manner. Before talking about the cryptocurrency equivalent to a dollar, let's look at what a dollar actually is. What is it that we're trying to create? And how are dollars created today? When you go to the bank and you want to get a mortgage to buy a house, bank doesn't have a bunch of dollars sitting around that they then lend to you. They create new money out of thin air, backed by your promise to repay the bank. New dollars spring into existence when you borrow to buy a house. And your loan, of course, is collateralized by your house. And you have to have 20% down, or if the market's shaky like it is today, sometimes they require more, like 50% down. So the bank gets a promise from you to repay that's collateralized by something that's worth twice the value of your loan, and new dollars come into existence, and then you can go spend those dollars. Now, these dollars are an IOU from the bank, and people accept them at face value because they believe that the bank can honor the promise. So I want to go one step further, way back in time before we got onto this fictional reserve system, and look at the original banknotes. They were a promise to pay $1 worth of gold. But what is $1 worth of gold? $1 is defined as a fixed weight of silver. In our laws, it's still on the books today, $1 is defined as a weight of silver. The original banknotes were promised to pay $1 worth of gold, not silver. And there's a ratio between the gold and the silver. When you went to take out your mortgage, the bank created a new banknote that they called so many dollars. There was a promise to pay $1 worth of gold. So $1 is not some entry or something that the Federal Reserve has a monopoly over. They have a monopoly over Federal Reserve notes, but not necessarily over $1. $1 is more like a unit of value, and it's a promise to pay a unit of value. Any centralized bank could create a new dollar, assuming people trusted that the bank's note was as good as a Federal Reserve note. And you're going to get $1 per dollar. That's how centralized systems work. And I apologize if that was a very rough explanation. There's an article I'll be publishing that goes through it in much more detail if you like to follow the analogy closer. Let's look at how a decentralized bank can lend dollars into existence. The first thing that needs to happen is someone has to be willing to borrow the dollars from the bank. And in order to borrow the dollars, need to post enough collateral to back the loan. In the case of BitShares, it requires a 50% down payment or 50% margin. If you want to borrow $100 from the BitShares decentralized bank, you need to put $200 worth of bank equity, which is the cryptocurrency, held as collateral. BitShares will then do a margin call anytime your collateral starts to become insufficient to secure the loan, at which point it will buy back the dollars that it lent into existence, pay off the loan, and destroy the dollars. This is the exact mechanism through which central banks create money by lending them into existence, and they destroy money when the loan is paid off. That, in a nutshell, is how a cryptocurrency can create dollars in the same way as a centralized bank.
Why would someone want to do this? Because it sounds like what you're saying is that in order to take a loan, I have to put more than I want to borrow on escrow at risk to collateralize that loan. So under what circumstances would I want to do this? What type of person would this be attractive to?
Oh, the reason people borrow stocks like Apple and Exxon, and they borrow it and they turn around and sell it. And this is called a short sell. And when you borrow it and then sell it, you can buy it back in the future for less money if the price goes down. And as a result, you make money. So speculators who want to speculate on the value of a BitShare versus the dollar can short a dollar by borrowing it into existence and then selling the dollar they borrowed. They can sell it for Bitcoin, they could sell it for actual paper dollars, but either way, they end up not having possession of the dollars. And in order to pay off the loan, they're going to have to buy them back at a future date. And hopefully, they're speculating, they'll be able to buy it back cheaper in the future and therefore make money.
Hi, listener. Here at Let's Talk Bitcoin, we're building a global network of correspondents able to contribute on-the-ground perspective when cryptocurrency-related information comes across their filters. If you'd like to join our global conversation, send an email with your name and geographic or cultural niche to apply@letstalkbitcoin.com. Just like Bitcoin, the only barrier to entry is your time and good work. Thanks for listening.
EasyDNS is the Swiss Army knife for your domain names, helping meet their customers' individual needs since 1998. EasyDNS has been an outspoken critic of SOPA and CISPA. EasyDNS was an early supporter of Bitcoin, and now they are proud to sponsor this show. Do business with a company that shares your values. Get a 13% discount when you pay with Bitcoin. Go to bitcoin.easydns.com and be sure to use discount code LTB.
You're trying to solve the decentralized exchange problem, and BitShares is essentially a new type of cryptocurrency that not only has this distributed exchange mechanism built into it, but that also lets you create new versions of it that track other real world items like, commodities or stocks or things like that. And so in that way, it's like a stock market and a currency market all built into a blockchain like structure. Is that right?
That's exactly right.
Okay, great. Terrific. I'm glad I was able to summarize that. So that's a big project. That's like a holy grail project. People have been trying to solve this decentralized exchange thing for a while, and it seems like it's a tough nut to crack. Where are you in that project, and what's next?
Oh, we've been hammering out the details. We've made a lot of progress toward implementing BitShares, but there's a lot of testing and a lot of work that needs to go into it before we can actually release this decentralized bank and exchange for production purposes. But in the meantime, a lot of people have expressed interest in being able to mine BitShares and get involved in BitShares today. So we came up with a concept called ProtoShares. It's sort of like the stem cell of BitShares. It's effectively an altcoin, Litecoin or the others, except it's got a new proof of work, which I'd love to talk about. And it comes with a social contract. And that social contract is that the Genesis block of BitShares will honor one for one. Every proto coin you have, you'll end up with one BitShare, which means if you're interested in speculating in the future value of BitShares, getting involved, promoting it, you can mine ProtoShares, and you can then profit as the value of BitShares grows, as the concept solidifies and more people become aware of how big this is going to be. And it all starts with ProtoShares.
So now we talk to miners and we talk to ASIC manufacturers. Who can actually participate in mining ProtoShares?
ProtoShares is based off of a new proof of work we invented that I call Momentum. And it is limited by the memory bandwidth of your computer. So that even if you were to develop an ASIC, it would not be able to operate any faster than your memory bandwidth. And a desktop CPU can already more or less saturate your memory bandwidth. So the proof of work requires about 1 gigabyte of RAM to run, which means any ASIC developer would be spending most of their transistors on RAM rather than on additional computational parallelism. As a result, I do not believe it's economically feasible to create specialized ASIC hardware for mining this.
Okay, so what you're saying is that this is targeted towards CPUs specifically, and that this is something where there isn't really an advantage to specializing on the hardware because general purpose hardware is about as specialized as you can get?
Yes, the technology that goes into making RAM as dense as fast as possible is highly patented. It's state-of-the-art. That is the largest component of the Momentum proof of work, is how fast can you address memory and how much memory do you have. So a CPU will be the best miner, provided that it's able to keep up with the memory bus. I've looked into whether or not GPUs can compete, and the PCI Express bus that communicates between your CPU and the graphics card is slower than the memory bus. So I do not believe that a GPU could even keep up just because of the bandwidth constraints between the different components on your computer.
We've seen claims like this before from like the script proof of work and things like that, where people claim that they're ASIC proof, but that's kind of like timed exclusive releases these days that you see a lot of times in media. You know what I mean? Like, how long is it's ASIC proof? I mean, like, is that, for a year, for 5 years, for a couple of months? I mean, until it gets worth enough money for someone to develop it?
I believe that, unlike everything that's come before it, this has a much longer shelf life because commodity hardware will continue to improve. I believe it is possible to create an ASIC that will be faster than a CPU by itself. I'm not claiming that's not possible. What I'm claiming is that instead of getting 100x or 1,000 times faster performance at significant power savings, you will only be able to see a 1, 2, at most 10x performance gain from creating an ASIC, and that the cost of such an ASIC is going to be primarily the RAM, and therefore there's not going to be these huge opportunities to profit. And I don't think that an ASIC would entirely displace the value of CPU mining.
Real quickly, I'm sitting next to a computer with 16 gigabytes of RAM. Is there an upper limit to how well hardware can do? I mean, is there a cap, or is it just as much RAM as you have, that's how efficient you can be?
Your memory bandwidth is the cap. You only need 1 gigabyte of RAM in order to get the maximum performance. You don't get any from having more RAM. We could tune the parameters of the proof of work for other uses to require more RAM, but we settled on 1 gigabyte as being a nice round number. So yeah, if you have a computer with a gigabyte of RAM that's free and a CPU that's able to saturate the memory bus for communicating to that RAM, you'll have about the best miner you can have. Now, there's different speed of RAM. Higher end your motherboard and the more recent your RAM, the better the miner you'll have. But it's not something that's going to grow by orders of magnitude without every computer out there getting the benefit.
Now, why was this something that you decided to do with these ProtoShares? Because, I mean, usually mining serves a couple of purposes, one of which is, frankly, to create and secure the network. So there is no network that ProtoCoins is securing, right?
The ProtoShares network.
ProtoShares, my mistake. But I mean, this is again, another way to get people involved with the project and give them a way to participate, right?
But it does two things. Normally, people raise money by pre-mining if they're trying to create something like what we're doing, and there's an opportunity to mine. We didn't want to pre-mine. We wanted to have everyone have an equal opportunity. And the other thing we wanted to be able to do is to establish a market value for BitShares, even before they exist, because they'll help us with raising money to actually develop it. So launching this, we're going to be mining it just like everyone else. As the value goes up, the ProtoShares on our books as a company gain value, and that allows us to raise money or potentially sell the ProtoShares that we have mined to raise money.
One of the difficult things about getting involved with a new cryptocurrency a lot of times is, especially when you want to mine, is that if you're not technically savvy or you don't have a background in mining, it can be kind of difficult to set that up. I know that with BitShares, you guys are using an entirely different code base. So I wonder, have you created a new solution for mining, or are you using the standard software?
It's new software for mining because it's a new mining algorithm. But for ProtoShares, it is actually a clone of the latest Bitcoin code base, where the only change that we made was to replace the proof of work and adjust the money supply, limited to 2 million. You will be able to download and mine ProtoShares as easily as downloading Bitcoin Qt, going to a menu item and saying mine.
Okay, sounds pretty easy.
We plan on having a Windows executable available for download immediately. If you're using Linux, you'll have to compile it from source.
And it won't be available on Mac initially?
I'm working on getting the Mac one as soon as possible. I use a Mac, but I need to work on packaging it up. So we've been doing a lot in this past month since C3. And the main things we have today are you can start buying your Kiot IDs, and you should visit our website to find out more about how they work and why they're valuable. And you'll be able to start mining ProtoShares. And if you sign up for our newsletter, you can get a heads up of where you can download the latest clients for mining. And of course, we're also going to be launching a beta as soon as possible for Kiot Mail, which is going to have all the experience of BitMessage, only easier to use. So you'll get to have a feel for the quality of stuff we're trying to produce. And that's what we've been doing.
Well, that sounds like you're making some exciting progress. Daniel, if someone wants to, why don't you give your website again one more time?
You can reach us at invictus-innovations.com.
Daniel Larimer, thanks again for joining us on Let's Talk Bitcoin. We look forward to your continued progress in the space.
Thank you, Adam.
This last week, Two researchers at Cornell University published a very interesting paper on a potentially new and different attack that miners could use on the blockchain in order to gain a competitive advantage against other miners. Now, we've already heard and discussed, I think, ad nauseum, the concept of a 51% attack, being able to take over the blockchain for many consecutive blocks by marshalling 51% of the hashing power of the network. What this paper talks about is essentially a shortcut that allows you to achieve the same thing, to achieve a predominance of the blocks mined coming to you, and do that with far less effort than 51% of the hashing, as low as potentially 28, 29%. Some have said even lower, maybe as low as 25% of the hashing power, in order to execute an attack called selfish mining. So this paper was posted and has received a ton of discussion. Obviously, it generated both some very sensible and great analytical discussion and food for thought among the developers. And it also generated a mountain of screaming sensationalist, Bitcoin is broken, my hair is on fire, we should all sell kind of articles. Let's talk about it.
Hey guys, before we start talking about this, I have some breaking news. Breaking news. The US dollar is broken. There's a group of people who can just print more at any given time on any whim, and they set the interest rates and they decide how much money is printed. Guess what? You can't really do much with it. You have to ask people's permission to get it in and out of a bank. You can't really take it across borders. Gosh, I think we should all sell our dollars.
That's a really great point, Stephanie. The absolute worst case, edge case scenario of improbable Bitcoin failure is that it becomes as useless as the dollar in terms of control, distribution of the power of control behind it. So in that worst case scenario, it would take 25% of the hashing power in order to take over the currency, whereas for the dollar, all you need is one chairmanship at the Federal Reserve. Which is appointed. So there we go.
Yeah, but I mean, it's appointed, but, at the same time, maybe that's a less scary outcome, because at least then you know who's doing the manipulation, as opposed to there being the potential for lots of people to do the manipulation, although albeit one at a time.
Very good point. I will just bat this whole theory away very, very quickly like this. This is a theoretical construct. It is absolutely fascinating from an academic perspective, and there's already a lot of discussion around how we can prevent the possibility of such a concerted effort. However, in practical terms, you cannot simulate the Bitcoin network the way they have simulated in the paper and draw rational conclusions, because it ignores a lot of the incentives that miners have not to kill the goose that lays golden eggs, which is their mining capability, especially if they've invested in hardware. And secondly, right now, the big motivation to be part of a pool is because you can get ready access to a lot of the mining capacity and services and more equitably share. But the more people who have ASICs, the less important pools are. So this is a highly theoretical issue that's generating a lot of academic discussion, but in practical terms, pulling such a thing off is almost impossible. Pulling it off without notice is impossible, and there are already countermeasures in place. So Bitcoin is not broken. Bitcoin is understood a bit better now.
Andreas, can you just back up for a minute and break it down for me? How exactly would somebody with perhaps a mining pool or a huge botnet or something, how would somebody with 25% of the network hashing power gain control over the network? Is this like they would use that 25% to do a 51% attack?
No,
explain this to me.
Yes, absolutely. So a 51% attack is where you use the hashing power of the network in order to mine blocks in such a way as to control who is on the correct blockchain. If you can dominate the blockchain, you can essentially double spend for a period of time or do various other shenanigans like that. It's a risky strategy that probably won't work in the long term. Now, with selfish mining, what the authors are suggesting is that if you discover a block, when you discover a block, the search for the next block after that, n+1 if you like, hinges on the block you just discovered. Now, if you don't tell anyone about the block you just discovered and just immediately go on to searching for n+1, you're the only one who can search for the n+1 block because you know the nth block. And if you have sufficient power, you could even go 2 or 3 blocks ahead of the chain. Once you've gone that far, then you can release your block. So what you're doing is you're selfishly limiting the propagation of blocks you discover so that you can gain an advantage on the following blocks after that and then release them all in one big rush when you've discovered several in the future. Essentially, not propagating blocks to the network when you find them gives you an advantage that you can translate into essentially a hashing attack. But here's the problem with this. In this paper, and in general an analysis of this, we look at the reward as if it's multiplied by probability. So if you find the block, right, and publish it immediately, you get 100% of the reward. And then for every second that passes that you're not publishing that block, the probability of someone else publishing another block and stealing your lead increases. So your reward probabilistically goes down to 0, right? And that's how they've modeled this whole thing. Here's the problem, though. You can't get half a reward. You either get it or you don't. So selfish mining depends on a rather risky strategy that would be easily discovered that has the possibility of destroying faith in the currency. It would take a stupid miner, a stupid network that doesn't react, to go against all of the incentives of the Bitcoin mining scheme to do it. So again, I think it is a very rare edge case. It's very interesting from a theoretical perspective. It means almost nothing from a practical perspective at this point.
Well, I don't think that was entirely it, though, was it, Andreas? You're right about the part that you explained, but I thought that the reason why having that blockchain that you're essentially keeping private to yourself is that if you can get a few blocks ahead and then release those, essentially you incentivize everyone else to jump onto your blockchain, which you're now several ahead of, right?
Oh, of course, yes. Oh, no, it's not incentivizing. If you release a blockchain that's 1 block ahead, then that is the current blockchain. If you release one that's 2 blocks ahead, not only is that the current one, but the possibility of someone else catching up with you is even lower because they have to mine 2 blocks in sequence. And at 3 blocks, you're really way ahead of the curve. So when you do release that, your chain will become the dominant chain. So essentially, you're able to do the same thing you would do under a 51% hash attack by simply mining the next n blocks in a row yourself without needing anybody else's help and dominating the network. But you're doing it by hiding the fact that you just mined some blocks and building on that success, essentially doubling down on the hidden block you didn't publish, and going a bit further, going for 2 blocks in a row, going for 3 blocks in a row. And the bigger that bet, the lower the probability you'll succeed, because all it takes is 1 block from someone else and you're out of the game.
Okay, so let's assume for a second that someone is able to pull this off and say they get 3 blocks ahead, and then the network switches over to them. Doesn't the network stay on that chain, which has been co-opted? I mean, does that matter?
It doesn't matter because at that point, the miner has already made the gains. They've been able to get 3 rewards in a row, and their second and third reward for the second and third block they mined on top of a block they didn't tell anyone about, so they didn't have any competition because no one was searching to extend that chain because they didn't know it existed. Essentially, you get further ahead without any competition, and then you dump it all in one go. And instead of locking in 1 block, you've locked in 3 blocks, for example. So it allows you to extend your lead with less hashing power than before. It's a shortcut on the 51% attack. It doesn't give you any more benefits than a 51% attack. It just allows you to take advantage of not publishing blocks in order to gain a slight edge on the other miners.
So who loses in this case? I mean, the other miners.
The other miners.
The other miners. Does anybody else lose? Does this matter to average users of the network at all?
And not in a single instance effort to do this. If this was done consistently, it would break down the incentive structure and the market, leading to miners withdrawing from the market because they can no longer achieve fairness. But that is a rather extreme scenario. That would assume that no one takes any countermeasures. And the discussion that's happening on the Bitcoin dev list is very interesting because you've got many of the core developers looking at this very seriously and also clarifying that you cannot do this without generating a trail of breadcrumbs that show that you did this. And if you do, there will be consequences. Peter Todd talked about how we're screwed on the dev list, and you should see the answer he got from Gavin. I gotta quote it. Because Peter said, look, if anybody wants to try this, here's my PGP key, contact me and I'll help you do it. And his goal for saying that was more as a challenge to the pools. Go ahead, try it, we'll shut you down. But Gavin took it the wrong way, and his response was priceless. He put on his benevolent dictator hat and went nuclear. This was at 8:56 p.m., quoting Peter's message. P.S. If any large pools want to try this stuff out, give me a shout. You have my PGP key, confidentiality assured. Gavin responds, if I find out one of the large pools decides to run this, quote, experiment, quote, on the main network, I will make it my mission to tell people to switch to a more responsible pool. And if you think you can get away with driving up everybody's orphan rate without anyone noticing, you should think again.
So this is another sort of interesting example of the core dev team not really having any power outside of the ability to talk and be listened to, but being able to kind of bring that power to bear on what otherwise could be, you know, something that people would want to try out. It's very interesting to watch how the dev team has to lead as opposed to other projects.
Right, absolutely. They have no authority other than code. But at the same time, they can write code and they can write code fixes. The trick is that they will have to draw a very, very, very fine line, because no fix you apply here could break the distributed consensus nature. It has to remain decentralized and open, right? If you put a rule that says we don't let pool X participate, or we're going to filter blocks coming from this IP address, you've opened the door to far, far worse things than a selfish mining attack.
Which is, of course, why it's good that Gavin has the benevolent dictator hat, but he doesn't actually have the gavel.
Exactly. And I think people will have to make educated risk assessments as to what's better, the problem or the solution. For now, quite rightly, what they're talking about is, let's gather more data, let's do more simulations, let's figure it out, and let's pay attention to this for the long run. Essentially, what this is new game theory. It's new game theory about the interplay between miners, mining pools, and incentive structures.
Is the Bitcoin price in a bubble? Only time will tell, but one thing's for sure. Bitcoin video passes are on sale. Normally $75 for those paying in US funds. Visit bitcoinvideopass.com and spend only 0.1 to 0.2 Bitcoins, 0.12 Bitcoins at the time this was recorded, to access all the talks and panels from the October cryptocurrency conference. See how easy buying with Bitcoin can be and experience instant access as soon as you've paid without even reloading the page. Check it out at bitcoinvideopass.com.
Hi, this is Jason King, founder at Sean's Outpost, and you are listening to Let's Talk Bitcoin. Sean's Outpost is a homeless outreach in Pensacola, Florida, and we are proudly powered by Bitcoin. To date, over 13,000 meals have been fed to the homeless in our area, all purchased with Bitcoin and through the generosity of the cryptocurrency community. Read more about us at seansoutpost.com. Food, shelter, Bitcoin, everybody. Sean'sOutpost.com.
So what does a consequence look like in the Bitcoin world?
I would expect the consequence, and among other things, a very, very public censure of the pool that attempts to do this, and a request by the core developers for people to abandon that pool. And I think that, you know, since this requires collusion by a lot of actors, public shaming would be very effective. But again, there are other countermeasures. This is a very unlikely edge case with a lot of possible fixes. It's a great theoretical analysis, but it looks at the Bitcoin network as an abstract state machine and not as a collection of humans driven by motivations that are not entirely rational.
So obviously, summarizing here, do you think that anything is going to come from this as far as the development team is concerned? Or do we think that this is something that now that it's understood, or at least, you know, people are knowing to watch for it, that it'll just be watched for? And if something happens to warrant a change will be made, but otherwise it's just watching? I
expect we're going to see better instrumentation of mining software.
Well then,
and
sounds like
we're probably going to see some more scrutiny on mining pools and their behavior and propagation tactics on the network to ensure that if someone is trying to attempt something like this, it is seen early on and quickly enough. So yes, this is having a tremendous positive impact on Bitcoin development, because while it is a theoretical case, it's a very interesting one. We can start looking at designing countermeasures. It's probably much more important in the future when fees are bigger than reward, because then it would change the way people prioritize blocks and transactions in blocks. So it has some important implications for later. It's a great academic paper. It's very interesting analysis. It's great computer science. but it is not a market disaster or a practical attack in any way at the moment.
So this wouldn't just apply to Bitcoin, it would apply to any altcoin too, right?
It applies to any blockchain-based currency.
So, I mean, actually, this isn't just great for Bitcoin and strengthening it against potential future attacks, but also for any altcoin. So, yeah, like I agree with you. I see this as a win.
Precisely. Here's the interesting thing. While it would be almost impossible to pull something like this on Bitcoin simply because of the amount of collusion, the size of the pool you have to assemble, and the willingness...
It's a grand conspiracy.
and the willingness to shoot a $3.7 billion market with a shotgun just in case you make some pennies on the side. You know, quite honestly, miners would have to believe that they can make more by messing the network now than by simply waiting and participating in the network, which I think is unlikely. But here's the thing. On an altcoin, none of these things apply. So we are going to see these types of attacks tried out on an altcoin, and we are going to see these failure modes play out, just like we saw 51% attacks, just like we saw upside down difficulty and retargeting problems when ASICs pulled out. The altcoins are going to be the laboratory where we will see these failure modes play out. And that's going to be another great learning experience. So, yeah, I'm not worried about Bitcoin. I think this is actually a great development.
So on the subject of the altcoins, I was thinking about this and kind of asking myself, now that this is something that's known, is it ethical to try this out? To organize an attack on an altcoin? Would it be better to tell the people or not? Or is it just better to let criminals kind of figure it out for themselves while they try to make it work?
As a security professional, I believe in responsible disclosure, and that means that if you find security problems, you responsibly disclose them to the people who can apply fixes, and then you disclose them to the public soon thereafter to force the people who can apply fixes to actually do something about them. That's been the policy for security vulnerability disclosure. It's worked well in that space. I think it should be applied to altcoins. Tell the founders, give them a week to fix it. Whether they do or not, then tell everyone.
But is this something that the founders of an altcoin could actually fix? Didn't you say it was kind of up to the mining software?
Well, yes, it's not just up to the mining software. It's more up to monitoring the network itself as it propagates blocks. And there may be different fixes, and they may not be able to directly fix it right away. We'll see. It's going to be interesting.
I remember seeing an infographic a little while ago where they were calculating the cost of mounting a 51% attack on the Bitcoin network and comparing it to the military budgets. The cost that they had calculated, whoever put this infographic together, was way more than most countries' entire military budgets. So that makes people feel good. But if it's that hard to get 51% of the network hashing power in the hands of maybe one person or entity, wouldn't it also be really, really hard with Bitcoin, since the network is growing all the time, to get 25%?
Exactly. I mean, that's exactly the case. So let's look at it from a different perspective. The hashing power now is what? Has it already passed 5 peta? I'm not sure. So it was somewhere between 4 and 5 petahashes. It was 1 petahash in August. It was half a petahash in June. So a 51% attack in June would have been a 250 gigahash attack, and a 51% attack today is a 2 petahash attack. So just in the last 4 months, the effort to mount a 51% attack has quadrupled.
Net are ASICs good or bad? Because I mean, on the
net ASICs are great because they put so much power in individual hands that pools are less important, and they've increased the hashing power so much that even a 25% attack is more than the entire network hashing power was just a few months ago.
You're saying that they take away from pools. I don't really understand how ASICs can take away from pools, because it's not like the number of miners actually trying to mine are going down. So isn't it kind of just...
And are people doing solo mining with ASICs? I didn't think that was
You'd have to have a lot of
workable.
ASICs in order to solo mine.
Over the long term, the relative advantage of having a pool, which increases your probability of actually finding a block as part of a pool, whereas you just keep trying and failing otherwise, the more hashing power you have in individuals' hands in ASICs, the less important that differentiator is.
But isn't that percentage-based?
It is percentage-based, but it's also, you've got to consider that pools charge fees, right? So at some point, it is more profitable to go out mine on your own if more people mine on their own. And by the way, one of the things that this 25% attack or selfish mining or whatever, the best outcome we can have from this theoretical analysis is to recognize that mining pools themselves, the concentration in mining pools is the problem. You can't do any of these attacks without collusion, and mining pools are the best way to organize collusion without having to get the approval of every single person. So in the long run, P2 pool, the peer-to-peer pool for independent mining, is probably our best chance. Start your own pool, get off the big pools. If it's more than 1% of the hashing power, get off it, get onto P2 pool, and take away the power of the big mining pools. And then none of these attacks matter.
You're asking people to do a thing that's against their economic best interest in the short to medium term, though. I mean, just right?
in the long term, though, the cost of the pool fees exceeds the benefits that they offer. So there is a point at which pools no longer make financial sense.
Yeah, but it has to do more with like a tipping point in terms of like the quantities of people who are in pools relative to not in pools. Because if everybody's not in pools, then yeah, you're right.
There's an easier answer. If tomorrow morning being in a pool actually enables the owner of that pool to take down the $3.7 billion economy that you just invested in through buying your ASIC, then you're going to leave that pool because the risk of them destroying Bitcoin is far greater than the benefit they give you. Basically, you're looking at your golden goose and the people around you have got a glint in their eye and they just pulled out a carving knife and you're like, I don't want to be part of this party anymore. Thank you very much. I'm leaving, because what you're about to do is going to be far more damaging than the benefits you give me.
Yeah,
that's
but how
one
often
thing that the paper does not take into consideration. The fact that if you understand how this is going to destroy Bitcoin in general, if it's pulled off, then you would not participate even if it gives you temporary advantage.
We talk about shining examples and horrible warnings, right? And so it seems to me that you can't really have a lesson of this magnitude lacking one of those things. There has to be a bad thing that happens, right?
Well, the good news is that if the type of selfish mining does happen, its impact will be minimal.
Yeah.
Its fix will be instant. The public backlash will be large and pools will be over. I think that's a far more likely scenario.
Thanks for listening to episode 57 of Let's Talk Bitcoin. Content for today's show is provided by Daniel Larimer, Stephanie Murphy, and Andreas M. Antonopoulos. Music was provided by Jared Rubens. Any questions or comments? Email Adam at letstalkbitcoin.com. See you next time.